People say to me, well, Rick, the gold price has fallen. And I say to them, well, as a buyer, that's a good thing, isn't it? Would you rather pay $5,000 for it, or would you rather pay $4,000 for it? If gold reverts to mean, gold and precious metals related securities reverts to mean, demand increases fourfold in the largest savings and investment country in the world. And that's what I think is going to happen. People not owning gold and not owning gold equities are a total mystery to me. People say, Rick, what would make you sell your gold? No problem. I'll tell you. You'd have to balance the U.S. federal budget. You would have to make political accommodation to pay down $40 trillion in debt. You would need political accommodation to solve the $120 trillion in the net present value of unfunded entitlement liabilities. And when the interest rate goes up, the capital expense of developing additional productive capacity in copper, in iron, in oil becomes more expensive. When I saw silver lock limit up every day, experience told me that what I had to do was sell. The reason to own the asset disappeared. I had a hyperbolic chart. I had to sell. Why do I say the sure money's ahead of us? Let's pick one commodity which is stupidly underowned, which is gold. People say to me, well, Rick, the gold price has fallen. And I say to them, well, as a buyer, that's a good thing, isn't it? Would you rather pay $5,000 for it, or would you rather pay $4,000 for it? If you'd rather pay $5,000 than $4,000, I have a house to sell you. Why wouldn't people buy gold the way they buy tuna fish or coats? Then I say to people, the price is down, is it? I began saving in gold in the year 2000. Gold was $256 an ounce. Now it's down to $4,100. Doesn't feel like down to me. But that's rear looking. Let's look forward, which is what your audience must do. History teaches us that gold does well during periods of time when investors and savers are nervous about the maintenance of their purchasing power in traditional savings instruments. We're in the United States, so let's talk about U.S. 10-year treasuries. The U.S. 10-year treasury, the world's premier benchmark savings instrument, yields 4.6 in a currency that I would argue is depreciating in terms of purchasing power by 8 to 10% compounded. If you do conventional arithmetic, you're making 4.6 in a treasury. If you do unconventional arithmetic, you're losing 4% a year. You buy a U.S. 10-year treasury, you lose 4% a year compounded for 10 years. It means that you put up $100,000 and you got back $50,000. Not a very good deal. Gold, now that it's down, in the last 26 years, has increased at 8% compounded nominally in US dollars.
Here is the truth about market dips. Well, regular investors panic and start selling everything, but Rick Rule views a gold price drop as a massive buying opportunity. He is convinced that the general public is majorly underinvested in precious metal right now. According to his analysis, once mainstream American investors wake up and return to their historical assets allocation habits, the global demand for gold is going to experience a massive fourfold explosion.
Put differently, has maintained its purchasing power. That's precisely what gold is supposed to do. My belief, and I can bore your audience if you want with all the arithmetic, is that the US dollar will duplicate its performance in the decade of the 1970s, which is to say it will lose 75% of its remaining purchasing power in the next 10 years. And gold, I think, will maintain its purchasing power. Gold will today, as it has always done, buy you a very fine men's suit. Maybe not at a hotel this expensive, but at a reasonable place. It'll buy you a very fine men's suit, an ounce of gold. And 10 years from now, it'll buy you a very fine men's suit. That same men's suit in US dollars will probably be a $15,000 suit in 10 years. So gold will maintain your purchasing power. Now, let's bring that down to you. Let's use you parenthetically because you're probably smarter than the broad population. The market share of gold and precious metals related securities in the United States relative to other savings and investment assets is 0.5%. Figuratively, this is a pimple on an elephant's behind. The 4-decade mean market share is 2%. If gold reverts to mean, gold and precious metals related securities reverts to mean, Demand increases fourfold in the largest savings and investment country in the world. And that's what I think is going to happen. People not owning gold and not owning gold equities are a total mystery to me. And we could go sector through sector through sector in extractive industries, and I could make a similar case. I wanted to pick on gold simply because gold is identifiable to many people.
Really great bull case that you're outlining there.
This is a powerful take on wealth protection. People always ask him what specific conditions would make him liquidate his precious metals. His answer is simple but deep. Until the US government balances its budget, tackles its massive $40 trillion debt, and addresses the $120 trillion entitlement crisis, he is never selling a single ounce. Basically, he is holding his gold forever because those problems are not getting fixed anytime soon.
Something I would love to pull a thread on is, you mentioned gold, of course, retains purchasing power. If you were to go back a few hundred years, you could buy a fine suit, and that's still the case today. Is there still an opportunity, as in sometimes in history has occurred, for gold to gain in relative value compared to other assets over the next few years, and what drivers would drive that forward?
There is absolutely the chance that that takes place. But I'm trying to make the case from a conservative point of view. I'm trying to tell you that your downside is upside. I'm trying to give you a case where the answer begins with when, not if. Can I give you an if scenario? Of course. If you look at the last period of gold's hyper outperformance, it was the period 1970 to 1980. During that period of time, the US dollar lost 75% of its purchasing power, and gold ran in price 26-fold. It is estimated, although statistics don't exist, that in 1981, precious metals and precious metals securities represented 7% of the savings and assets of Americans versus 0.5% today. If gold didn't revert to mean, which is to say a 2% market share, and went to a 7% market share, there isn't enough gold on Earth to fill that demand. That's an if. Okay, the point is, I don't need to make the upside case to make my case. I need to make the downside case. And I challenge any of your listeners to challenge the downside case. People say, Rick, what would make you sell your gold? No problem, I'll tell you.
There is a huge lesson here about trading discipline. Rule explains that when interest rates go up, the cost of producing essential commodities like copper, iron, and oil rises drastically. But look at his brilliant move with silver. The moment he saw the silver chart shooting up in a vertical parabolic run, he took his profits immediately. He did not let greed take over because he knew the logical fundamental reason to hold physical silver was officially over.
You'd have to balance the US federal budget. You would have to make political accommodation to pay down $40 trillion in debt. You would need political accommodation to solve the $120 trillion in the net present value of unfunded entitlement liabilities. You need to find a way to say to me, an old guy, yes, you've paid into Social Security for 60 years, but there's no money, so you don't get any. And you'd have to have a positive real interest rate. If the purchasing power of the US dollar is declining at 8% compounded, I would need at least 150, maybe 200 basis points yield on top of that, which is to say the US 10-year Treasury would have to be yielding me 10. The first mortgage rate in the US would have to be 12. The prime interest rate in the US would have to be 11. How long do you think the American taxpayer would stand for that? The probability of the circumstance occurring that would cause me to sell my gold within 10 years is, I think, functionally nil.
It's an incredible point that you're making. Of course, the fiscal responsibility, the demographic side of the equation, and keeping up with this debasement would be incredibly impressive for any asset class. And I really struggle making the case for almost any other than gold to actually be able to keep up to the massive amounts of money printing that you're outlining here.
Well, again, if you dial yourself back to the decade of the 70s, assets that are denominated in dollars when dollars are devaluing become nominally more expensive. It's important that people realize that. The second thing that happens is that later in a cycle where inflation occurs, the interest rate goes up.
If you think your cash is safe in government bonds, you need to hear this. Locking your money into a 10 years US Treasury might give you a 4.6% nominal return, but it's a mathematical trap when you factor in real world inflation, which is equally burning away your purchasing power by 8 to 10% every single year. You are actually guaranteed to lose half your wealth over the next decade. Traditional savings are literally losing your money.
And when the interest rate goes up, the capital expense of developing additional productive capacity in copper, in iron, in oil becomes more expensive, which favors the incumbent producer. If your ability to add incremental supply becomes more expensive, you add less incremental supply. So the existing supplies become rationed by price. That was something we learned in the decade of the 70s. People look at the increase in the oil price over the course of the decade, and they blame the Arab oil embargo. They forget the fact that society underinvested in oil for 20 years before that decade, and they forget that the capital expenditure associated with developing new supplies increased exponentially as a consequence of inflation during that decade. They don't understand the reasons behind the price appreciation. And the reasons behind the price appreciation that occurred in the decade of the 70s occur today in the same fashion.
I was going to say that sounds like a situation very familiar to the oil situation today, which I would love to park for just a second. Perhaps we can talk about the gold miners, which of course people tend to think they provide leverage to the underlying commodity as they're the producer of it. Costs would hopefully remain flat, but in a money printing environment, debasement environment like you're outlining, costs will rise.
That's correct, and are rising, not will rise. It's important that you note that. It's important that gold mining investors pay attention to the inexorable increase occurring already in all-in sustaining costs. As an example, open-cut mines in particular are extremely energy intensive. An increase in the oil price hits, and it doesn't hit you 3 years from now. It hits you 3 months ago. The second thing that's happening, and the industry's noted this in industry conferences, is that the inputs with regards to building mines are increasing